Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Ross, we have a listener question. They want to know, they've heard that condos have been recommended as a way to enter the market and as a way to invest in real estate, and they ask, Ross, is a condo a good investment going forward?
Well, it's funny, my answer really would be no different today than it would have been 2 months ago, a year ago, 2 years ago, 6 years ago, 10 years ago. Condos have always been a very risky investment. Now, for me, I'm lucky because when I started in the real estate business, I was 3 years only into it for about 3 years before the great house price correction began in Ontario in 1990. So I watched what happened to people who had been investing in condos in the 88, 89. I watched what happened to them. And I read the newspaper stories of what happened in Toronto. I read some history on it at that time, going back into the 70s. And in the 70s, the exact same thing had happened. At that time, in Ontario, they believed that there was speculation going on in the housing market, and the premier at that time, Bill Davis, he brought in a speculation tax on land. That speculation tax was virtually 100%, which overnight wiped out the condo market, because the condo the condo market was built on flipping of land by developers that raised the price of the condos. So the exact same thing that you've watched happen in Vancouver from 2010 forward and in Toronto from 2011 forward happened decades ago exactly the same way when I'm referencing back to 74. This isn't something that's new. So my answer to the condominium is always the same. Look with the condominium, you're always, unless you are buying a high-tier property. So in other words, you're buying a condominium in a building where wealthy people live. You are always going to be at higher risk than if you don't buy a condominium. The reason for that is this. People get into a condominium. Let's say condominiums, about 70 to 75% of all condominiums fall into this category, which generally speaking means the ones that are the lower price point, or ones that have a younger demographic living in them. So those condominiums are always concerned about condo fees. In Vancouver, this is why you have leaky condos. This is why you have your insurance premiums going up and condominium boards not being able to pay them. Most buildings are that way. There are a few buildings in a city where that doesn't take place, and that's usually where you have mature owners that are above the age of 50 are the predominant ownership group in the building, or you have wealthy owners. And those owners are in a position in life where often they don't have mortgages or they have enough wealth that they want to make sure that the building's taken care of. So those buildings, it's okay. So the condo question, as you can see, Jim, is answered identically today as I would have answered it after watching what happened in 1974, which I didn't watch because I was only entering high school at that time. But what my review of history in the late 1980s revealed to me about the early 1970s housing market, condo market in Ontario. And that is, land will get flipped. So as builders are able to get a little tiny bit higher per square footage charge on the condo, that sets off a series of events that take place. You end up going from condominiums being built for $250, $280 a square foot up to $1,000 a square foot. And people believe, because all of the stakeholders talk that way, that that is a legitimate price to charge for a condo. And it's not. It wasn't correct in 1974. It wasn't correct in 1990. It wasn't correct in 2008, and it's not correct today. You have to use a historical perspective when you're talking about real estate. I guess a certain point of the irony is that of this conversation today, Jim, is China, because the Chinese people have a 30-year view on real estate. They have a long-term outlook, which is why you saw foreign speculation in ultra-luxury class homes in Vancouver. It's why we didn't have any real impact on the housing market in Toronto from foreign buyers, even though you have a couple local realtors who haven't sold any homes in their careers in Toronto pretending that that was the case. It really wasn't the case. So your listener has to understand, if you're going to buy a condominium, you probably want to buy into a building that's about 3 years old. You're only going to want to hold it for about 5 years at the most. So with that context, if you're getting into the market, then the only other qualification you have to have is that you're buying in at the right time. 2020 is not the right time. 2021 will not be the right time. The right time might have been 2012. Maybe even 2013 might have been the right time to buy in, because the housing market, the national housing market at that time was still contracting. That was before Polage took power and began to lower mortgage rates in the fall of 2013. That's before organized real estate started counting for sale by owners, which created the false illusion of house price sales increasing beginning around July of 2013. That's how I would have to answer this listener. In terms of a condominium, you have to be super risk averse. Unless you're buying into a wealthy condominium, in other words, a building where wealthy owners own units, or you're buying into a building where people are of an older age group. Because what those people won't do is they won't let their homes be at risk. They'll make sure the condominium fee is adequate to cover needed repairs. That maintenance schedule that those condominiums will adhere to virtually assures you of having a constant condominium, your monthly charges, your condominium fees, your strata fees will not go up probably other than 3 to 4% a year. They will manage the condominium properly. They won't outsource management. They have the time, and they're astute enough that they can handle the management in-house. The rest of the owners of the building then hold that group who is overseeing it accountable. You're not going to see that in the other 75% of the condominiums that are out there in the marketplace. So, generally speaking, I am not an advocate for entering a housing market in a condominium. I will say that doing so in non-dense cities is probably far safer. In other words, if you were to go to Abbotsford or in Vancouver, if you go out to Oakville or Burlington or Vaughan in Ontario, you really can't do this in Alberta. Quebec, you could move to the outer suburbs of Montreal and done it safely probably there, because those buildings, there's not the abundance of buildings don't exist. So the category of buyer who is buying in a condominium in those places is simply more astute to what they're buying into, because the environment, the real estate environment in those communities is more risk adverse. So that's how I'd have to answer this listener. You just have to know what you're getting into going into it. What I can tell you is this. If you hear someone prognosticating about condominiums being a good buy, they really don't know what they're talking about. And if they're advocating first-time buyers use this without having a whole bunch of caveats in place, the advice they're giving is simply to earn a commission and nothing more.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, much has been made in the news of tightening credit and the inability of home buyers to get mortgages. Another listener asked us, can you ask Ross to comment on our ability to qualify for a mortgage after the lockdown opens back up?
Perfect question, Jim. Leads right into the question in the previous segment. And I'm going to answer it in that context as well, okay? In the previous segment, we were talking about condominiums being a good investment. Okay, so here's the situation that a nation of condominium first-time home buyers faces today. They are facing mortgage renewals coming up for the first time since they became an owner of a brand sparkling new condominium. You have places in British Columbia where you can't get insurance on your strata. You have an environment where insurers are going to be apprehensive about every new condominium that has been built in the last 7 years. You have valuations that are insane. You have people who have paid $600, $700, $800 a square foot for a common grade condominium because they believed everything that they were told about how much condominiums are going to cost more and more and more. It is a falsehood. So you've got all of those problems going. Then you have this Airbnb fiasco where YouTube stars like Grant Cardone and his cohorts in the States, RENIX networks in Canada, where they have sold investors on these strategies, are now being debunked as fraud. You can't buy residential real estate and expect to make it be profitable long term with Airbnb, because sooner or later legislation will be passed that is going to eliminate that the investment strategy that you're using, holding on to it. So you've got this massive all over the place situation with condominiums happening coast to coast in this country that is coming home to roost probably in about 2 months. It's how we see it. It's this clown show of stories that have been told over the last 7 years that are just simply going to get debunked as hogwash. And this now entails into this mortgage question that you've asked. So will our ability to qualify for a mortgage change after the lockdown? No. Whoever is spewing that nonsense is totally incompetent and ignorant to how mortgage money is lent in this country. Now, that said, the clown show in the condominium market will impact my comments about this topic as well. Because in those instances, the bank is not going to be tightening credit. What's going to happen is the appraised value of the unit is going to radically drop. It's going to change. It's going to change in a way that no one's ever told you it's going to change. It's going to change in a way that you're not prepared for. But I'll tell you, mortgage credit will not tighten. What I mean to say by that is this. In 1990, when I was selling, late 1980s, when I started selling houses, my clients were spending 36% of their income buying a house. I really can't remember. So few I can remember the odd outlier because they were unique individuals who did not purchase a home at a minimum 32% of their income. I can also tell you that in 2016 in Vancouver, 2017 in Toronto, people were spending 36% of their income on their home. I will also tell you, in 2021, people are going to spend 36% of their income buying their first home. The government is not going to change that. This is what your listeners have to understand when they're hearing other people talk about tightening credit. The Canadian banks have no need to tighten mortgage credit on CMHC insured loans. The predominant way that people borrow money and how cash flows into a housing market is through CMHC insured lending. CMHC insured lending guidelines have, even though they've changed in small ways, and I can be critical of some of the ways that they've changed over the last 8 years, I also have to say, for the most part, they remain unchanged for the last 30 years. They remain identical. They will be identical as we move out of this lockdown. That means if you could afford to buy, if CMHC would have told you 2 months ago that you could afford to spend $600,000 on a home, as long as you have the same job as you get out of this lockdown, CMHC is going to say you can spend $600,000 on a home. You will spend $600,000 on a home. What will be different is this. The amount of home, the quality of home that you're able to buy for $600,000 will be substantially better than it was 2 months ago. This will be coast to coast. The mortgage credit itself will not be tight as it pertains to CMHC insured mortgages. If you understand how housing markets function, in other words, once a first-time buyer enters the market, you know what is going to happen in the second, third, and fourth home trade that will result from that. You also understand that those home traders will be in a financial position that the banks or CMHC, which in most of the cases CMHC will not be involved, will still lend them the identical amount of money. This tightened credit myth, I don't know how it got out there. I don't know how it got believed, but it is a falsehood. Unless CMHC or the OSFI changes the lending criteria to approve you to borrow $1,000 of mortgage debt, your ability to access that mortgage credit will not change. Now, in the secondary lending market, markets where people go out and look to get a second mortgage, or where people have an income that allows them a higher degree of spendable income that exceeds what CMHC will allow them to lend. So this is where it gets a little more complicated for people to understand this credit tightening discussion and why the pundits that are commenting on it are always wrong. It's why mortgage debt in Canada has risen consistently since 1980. It hasn't dropped even in recessions. As you earn more income, you do pay a higher degree of tax, but generally speaking, your monthly expenses don't go up. Yes, there are the people who go out and buy the BMW, the Mercedes, the cottage. Okay, there are those people, but they are not the vast majority of homeowners. The vast majority of homeowners find that they have a higher and higher amount of money at the end of the month left over. They go to the bank, these people, and the bank says, "Oh, I'm sorry, we can only lend you 36% of your income." And they The people say, what do you mean you'll only lend me 36% of my income? I've got an extra $1,000 a month left over that I didn't have 5 years ago. So why are you telling me you're going to restrict my lending to the way that you would treat a first-time home buyer who is at their earning curve way, way below mine? Well, I'm sorry, that's the way that the mortgage rules have been set up. This, again, goes back to where I've discussed on the show. The legislators don't understand how the rules and policies that they put in place interact with the citizens of Canada. I'll leave that discussion for another day. Those home buyers who have an extra $1,000 available can't spend it on their house. The government wants them to spend it on something else. The government says, no, you can't spend that extra $1,000 a month, or even a part of it, on your house. You've got to spend it on taking a vacation. You've got to spend it on buying fancier clothes. You have to spend it on a fancier car. You have to spend it on savings. You can't spend it on owning a more expensive home. So what those people do is that those are the ones that the secondary mortgage market was really built to accommodate. And the vast majority of the secondary lending market is not at risk because of this understanding. Now, you still have the outliers, that top 10, 15, 20% at times. This is cyclical as well. That are where the secondary mortgage market starts to charge extremely high mortgage rates, 8%, 6%, 8%, something of that nature. You know, I've seen some as high as where they were offering 11%. Those are people who should be selling their home because they are not people who should be taking out more mortgage debt. Things are not going to get better for them going forward. But the vast majority of secondary mortgage debt, and that mortgage debt where people are only paying 4 to 5% interest, and they're only going to pay it probably for a 4 to 5 year period before it gets rolled into their home mortgage, that's not going to change. CMHC mortgage debt is not going to change. There is the tightening of credit is going to be next to nil. And it's only going to be a tightening of credit to credit that never really should have been extended in the first place. So for 90% of Canadian families, this will not impact you one iota unless you lose your job. But you know something? If you lose your job, it makes no difference whether it's 2020, 2010, 2000, 1980, 1990. It makes no difference. You weren't going to be able to access mortgage credit anyways. So the mortgage credit tightening myth has just been debunked with legislated rules and regulations that the entire mortgage business is built upon.
Ross, you mentioned Airbnb. Now Airbnb is asking for government handouts. Should they get them? And if so, or if not, why?
No, they should not. They should not get a nickel from the government. I do not believe there is a landlord in Canada who should be given a nickel. Now, this is where I'm coming at on this topic, Jim. If you are a landlord, you are an investor, a real estate investor. If you're not, you're an idiot. A real estate investor needs to build in a 6-month vacancy contingency fund into their investment strategy. What that means is that you need to have 6 months of interest debt, savings in a fund of the amount of interest that you're going to have to pay, plus property taxes, if it's a condominium, your strata fees, over that period of 6 months. You need to have that money included in your down payment. Okay? Now, I believe you should have a separate fund where that money is placed. I believe that fund should be in a GIC or in some reliable dividend earning vehicle. Which again, I would say, talk to your financial advisor. Let them give you guidance on a zero risk way to invest that vacancy fund. But that's how you invest. you also profit from that vacancy fund. So this only adds to your real estate investment. If you never need to use that vacancy fund, your profits go even higher. But your minimum expected annual growth rate on your equity should be based on the lowest rate of return you're expecting to get, not the best. Now, if you say, okay, well, a condo investor, he bought he got convinced by somebody to buy an investment condo, and that condo, his tenant in it, who's been paying a market rent, maybe 10, 15% higher than really what the market rent for that property actually is. We determine market rent totally different than everyone else does. We call this a sustainable rent. If an investor has built their real estate investment on that, too bad. You made a mistake. Sell the property. Sell it at a loss. Put it back onto the market. There is no need, Jim, in my opinion, when we have 50 years of home ownership, housing data, investment data at our fingertips to look at for the addicted homeless person on a street in Vancouver not to have a dollar being used to get them out of the situation that they're in, and instead being given to someone who made a bad real estate investment. Airbnb real estate investing was the most riskiest scam that has come up in the real estate investment market since Tommy Wu was appearing in TV ads in the 1980s. It's that bad. It's that risky. Only extremely wealthy investors should have even ever been considering that. And those investors can weather this storm. They can put those Airbnb rentals back on the market. They can take an immediate drop in price of tens of thousands of dollars and still be okay. I see, this is how we look at things differently, Jim. You asked this question about Airbnb. So here is my solution. Here is how I would talk to a politician. Look, don't give an investor, commercial even, a rent rebate or subsidy, okay? If the landlord needs to sell that real estate, so be it. Because it's a double benefit for your society. It's a double benefit for your voters. Number one, those are the properties that are the first to trigger lower house prices in the area that unit is located. If it's a condominium building, this is even better. Because those owners can afford to take a drop in price. So let's say they list the property 5% below what the previous sales were. A first-time buyer could run in and buy that unit. All the other ones are for sale. Immediately, all those other units are worth 5% less because the appraisal will have to reflect the lower selling price, which brings down all the values of the building. So the stupidest thing that, like, really, you know, to me, when I use the word stupid, it means someone who is ignorant or not qualified to comment on something, but they comment on something as if they are qualified. So when a politician or the politicians are talking about, oh, we've got to give landlords a subsidy so they don't come after the tenants, or so because they're in such hardship. No, you have believed talking points from the Landlords Association, for the stakeholders of that community, which also happen to be real estate agents and real estate brokers, and the developers. They're all in cahoots. They all want this Ponzi scheme to keep going forward. Commercial landlords. In a city like Vancouver, there is no need to give a commercial landlord a discount. If the commercial landlord believes he can sell his building for more than what it's worth as a rental, sell it. Maybe the tenants that are living there will buy it. Because what you'll find is, since the existing tenants cannot afford to pay the rents they're paying, the building is actually worth less than what they believe it's worth. Unless the city gives that owner permission to remediate that building, i.e., tear it down and build up a high-rise condo of apartment buildings, that value of that building is solely dependent on the rents you can get from it. Why would politicians make changes that effectively increase rents? If you give a landlord a discount a government-sponsored discount. You take $1 from housing a homeless person, an addicted person, a senior who needs care in their old age home. If you take $1 away from them and you give it to the landlord, you're making a bad political decision. It's one that is stupid because it's ignorant and it lacks any degree of competency in understanding how housing markets function and the value of how real estate changes over time. That's how I did that one.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, we heard yesterday your forecast about the house price index came true, but checking out all the newscasts and newspapers, I didn't see any references to the house price index at all. Normally every media outlet would have something on it. Why the silence this time around?
Yeah, it's funny, isn't it, Jim?
Yeah.
It's funny. Funny. After years of making headlines with the house price index, Internet National Bank House Price Index, the papers were kind of quiet about it yesterday. I think when we checked, there was only one. I think we've been warning about this, I guess, since the OSFI changed their mortgage lending rules through B20. Must be a coincidence. We sent out a warning about this a couple of shows ago, and lo and behold, on Monday morning, when we logged in to our Twitter account, we found we were blocked by the Internet National Bank House Price Index. Strange. They blocked us. Now, you have to understand in our account, Jim, I don't think there's ever been a swear word ever issued. I don't think there has been anything that violated Twitter's terms of service ever taken place. I think for your listeners who listen to the show, they can see that, you know, I really am not one to judge other people, but I am one to call out shills and hucksters who make false claims about a housing market that our data debunks. Every single person who has ever Twitter blocked us, or corporation that has Twitter blocked us, has been someone where we have counteracted their tweet with data. In other words, we simply went back and said, what you said was false, and here is the data that proves you're false. So that means that people like Evan Siddell, the CEO of CMHC, who blocked us for exposing his fraudulent comments about his mother for 30 plus years, getting a 16% compound annual growth rate on her house, something that anyone with any grade 5 with a calculator could disprove. He blocked us. Every housing pundit that you see on television today has blocked us. They haven't blocked us because we said something mean, we've sworn, we said something nasty. They blocked us because we disproved their tweet with data live on Twitter. Obviously, this has now gone on with Internet National Bank and their house price index. You see, what Internet National Bank doesn't understand is that our relationship with National Bank goes back to the 1980s. I have clients who are senior executives at National Bank. Now, I'm not saying that they're using my services today. I'm saying that they were my clients for years on end. Now, that also means National Bank, this is kind of hurtful. We were the first real estate brokers in the nation, the first mortgage brokers in the nation to secure a discount of a mortgage rate. That was 1/8% in 1988. It was initiated by the National Bank. That was the very first advertisable discounted mortgage rate in the history of this nation. We were lucky enough to be having enough volume, and National Bank wanted to break into our market. They opened a new branch. Guess what? The manager of that branch bought a house from us. Guess what happened next? He wanted us to start sending our mortgage business to him. Guess what? We insisted upon a mortgage discount for our clients. It took us about 2 months for him to work through the upper echelons of the National Bank before we had permission that we could advertise a mortgage discount of 0.125%. I hope your listeners understand how crazy that sounds today. We were bragging about getting 0.125%. But when you're the first people in Canada who were able to say that and then run an ad saying it, hey, that was kind of a big deal back then. So I suspect National Bank pretty much knows who we are, and they know where we're tweeting from. And the house price index, as we have said, is about to be debunked for the fraud that it is. Your listeners should understand, if they are holding bank stocks, that the loan-to-value ratios of all Canadian banks are updated quarterly in the shareholder reports using the Teranet National Bank House Price Index, with breakdowns supposedly at the forward sortation level, which means your postal code. So the last 3 digits or the first 3 digits of your postal code. That's the granular level of price change they claim to be able to record. Now, I want to tell your listeners just how nutty this premise is. There were only 3,800 houses that Teranet National Bank used for the entire GTA in the month of March. In other words, there are literally dozens and dozens and dozens and dozens of CM forward sortation FSAs, but there were only 3,800 houses. There were FSAs where there was not a single sale that took place. Yet, your banks are going to update their loan-to-value ratios using those metrics. What happened in July and August of this year? The Teranet National Bank is going to have so few pairs of sales to use in their algorithm. So few, not even the most ignorant risk management CEO at a bank is going to accept it. They are going to have so many FSAs where they don't even have one single sale that took place. It's going to debunk the fraudulent methodology, in our opinion, used by Teranet National Bank in these house price algorithms. In the same time, in the United States of America, the Case-Shiller Index is going to be debunked for the fraud that it is. There simply will not be enough homes sold and closed in some months to support the methodology that has been the Canadian and the American public has been asked to believe since the inception of these house price models. There is a reason why the Teranet National Bank year-over-year change for Toronto, which means, by the way, folks, the entire Toronto CMA was 6.69% in March. Oh, magically, guess what the annual rate of change with the Toronto Real Estate Board was over that period, which measured, folks, multiple times the number of properties the 3,800 that Teranet. So many multiples, it's embarrassing for anyone using that index. Oh, all those multiples, more than 10 times more, folks. More than 10 times more. More than 20 times more, folks. More than 20 times more the number of homes. You still ended up with a 6.69% change in March, year over year. You are watching live in real time all the myths about housing markets get debunked. I can take you to streets anywhere in this country right now, and the homes that have sold over the last 7 days, I can prove to you how much in price those homes have dropped, the value of those homes have dropped in the last month. You are not going to read that anywhere. Anywhere. You're not going to read it from organized real estate. You are not going to read it anywhere from an economist. You are not going to read it anywhere from an academic, a university professor, a planner, a realtor, a real estate board. You're not going to read it anywhere because they are under the false belief that the average purchase price equals the average price of a Canadian home or the average price of a home in their neighborhood. The change in the average purchase price measures change in the average home price. It doesn't, folks. What I will tell you is that virtually every high-volume real estate broker in the 1970s and 1980s in this country knew this to be fact. My father taught it to me when I started selling real estate in 1987. His uncle taught it to him when he started selling real estate. This is a factual reality of a housing market. And what the Terranet National Bank House Price Index is allowing you to see in real time, there are about, let me give you the number so I'm not confusing at the end of the show here today, Jim. Let me just pull this up and let me double check. Here's what your listeners need to understand. Terranet National Bank is claiming on the 3,800 homes that they sold, that they measured. They were measured a 6.69% year-over-year house price change. We will tell you, in the 92,000 homes that the members of the Toronto Real Estate Board sold in the last 12 months, the percentage change was 6.7%. Identical. In other words, supposedly, the better measure, which only measured 3,800 homes, is equaling the exact same measure of 92,000 homes. Now, can you imagine making the biggest investment of your lifetime believing these shills and hucksters? Can you imagine entering 25 years of mortgage debt payment relying upon this nonsense? There has never been an opportunity in Canadian history, real estate history, where real estate myths are going to be so readily available to be debunked than are happening right now. I can tell you, real estate stakeholders across this nation and America, their knees are clattering right now in fear because everything that they have told you to believe, that flat world belief they've wanted you to believe, is about to be debunked in real time. That opportunity has never existed before. The falsehood that have been allowed to be perpetuated, that have allowed people to gain international acclaim, Robert Schiller in the States, for their false metrics, their false understanding of how housing markets function, is going to be debunked. I will put my word on it that how there is not a single street in Canada where over 32 days house prices have ever changed in history. I will put my reputation, I will stake my reputation on it. There is not a single street in North America, and let's just stick for Canada for the sake of this conversation. There is not a single street in Canada where you can prove with data that house prices have changed in 32 days. Yet you have a global group of citizens who believe they did. You believe the world is flat. You might think you feel something's wrong with this conversation. You might feel like I really was kind of questioning those crazy 30% house price gains the local real estate board was releasing in Vancouver. Those crazy 40% year-over-year claims that they were making in Toronto. Those claims are going to be debunked in real time right now. Terranet National Bank, by Twitter blocking us, the night before they released March's house price index, made a critical mistake. Their metric, which they have revised several times over the last couple of years when we've caught them, they went from one measure, they dropped the 6-city composite, they went to a 3-month smooth, seasonally adjusted number from the pure number, monthly number, before we exposed the fraud, to now trying to think we're not going to be able to broadcast the errors we see in the methodology today. I'll leave this with your listeners. If you go to the OSFI website, you will see warnings issued in 2014, 2015 from the OSFI against the Canadian banks relying upon a single house price metric to use to update their loan-to-value ratios on their mortgage books. The reason why? Because the OSFI was aware there could be a problem with the Canada National Bank House Price Index. That is the only reason why that change happened. The subsequent change of the institution of a variable gross debt service ratio, which again, you haven't seen published anywhere, was a result of that information as well, as far as we're concerned. Hey, maybe it was all a coincidence.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, and you'll notice we answer a lot of questions in our show, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.